What's up, everyone? This is Peter Neill from GSP REI, and you're listening to the Real Estate Investing On Point podcast. This podcast is designed to help both active and passive real estate investors take their real estate investing game to the next level so that you can grow a successful real estate investing business or find out what to look for when you're investing passively in a real estate investment business. Let's get right into it. All right. Welcome back for another episode of the Real Estate Investing On Point podcast. I'm here with my partners, Ron Lockhart and Wade Carroll. Gentlemen, how you feeling today?
It's great.
Good.
Beautiful day here in Philadelphia.
Yeah. Well, let's just hop right into it. I mean, we finished the first episode getting into a conversation around knowing your market, getting beyond just the headlines and things like that. And, let's talk about from our perspective, what are those things that we look at when we're looking at a new market, when we're looking at existing markets that we're already investing in, what's our mindset around it? And Wade, I want to start with you because, the note portfolio is spread between over 40 different states. And then I'm assuming within those states, we're in a whole lot of different markets. So you have to you have to find out, what's the value of this property. What is it that you're looking at when you look at a market, when you do your research and things like that? What are the top things that you tend to look for first?
Should we have changed clothes? So we're doing 2 episodes in one day.
I was thinking
it's supposed to be like weekly. Put a different shirt on.
We're not going to be that. We're not going to be that fancy. Like we're Steve Harvey with the Family Feud. We'll just put a different suit on every time. No, let's not get that fancy.
Okay.
I think people understand how this stuff goes.
Yeah. So market research. We do pay attention obviously to the markets quite a bit. And we typically start, and I'm going to speak to notes because that's what I know better. But obviously notes are backed by a piece of real estate. We usually start with more general core logic type information. When you're assessing an entire state at a time, obviously there's many markets inside there, but, and again, I spoke to California earlier. So when we look at California, you're looking generally what the real estate retrades are looking like. Are they going up? Are they going down? And you can see quickly in a state like California, when you get over coastal, those prices have boomed in the last several years, and they're starting to, trickle down a little bit. Juxtapose that to the counties that are more inland. The reverse is true. Property values continue to rise. They're more affordable, so transactions are being done. People that couldn't afford, the coastal properties are back out. So yeah, we pay attention to that sort of thing. From a rental perspective, it's pretty easy to arrive at what I like to call just the rent to value ratio, the annual rent divided by the property value. And you're looking for 10 or better, really. So those are pretty easy metrics you can find with just a little bit of research, even on Zillow, if you have to rely on Zillow. But yeah, there's a whole host of MLS information. And as long as you can plot, the appreciation rate, or that the days on market are increasing or decreasing, because it's all a giant spreadsheet, right? You're putting in data points and then trying to predict that cost to capital over a period of time. If days on markets are elongating, where you're plugging that in, and it's going to cause you to bid less. If days on markets are shrinking, then that's a good sign. You can pay more, right?
Well, let me stop you there, Wade, because you make a good point. You're saying you're basing your pricing, what you're going to pay for the asset off of the market. Is there a time when you would say, I don't want to be in this market at all? I mean, and this is going to be different for somebody like you compared to a one-off, real estate investor who's maybe just buying a couple houses a year or something like that. But, are there markets where you would just completely avoid 100%, or is there always going to be a price that would make sense in almost any market?
I mean, there are places we avoid, right? But then, had you asked me this 10 years ago, I'd have a different answer, right? But right now, the rising tide raises all ships, right? So just about everywhere seems to be working, especially if you have an advantageous entry point. But typically, I avoid California just because everyone wants California. Typically, I avoid Florida because everyone wants Florida. I don't want to have to pay 80 cents on the dollar for a Florida asset when I can get New York for 45. I'd rather take the time and make the money than compete. And again, this is specific to notes. But yeah, there are markets I avoid now, but that's more because the competition is so high. Georgia with very short foreclosure rates, it's very competitive. So I like to go to markets where it's less competitive. Everyone avoids Cook County, Illinois, because it's miserable. Yeah, you can buy them a lot cheaper there. So if you've worked out a process that you can manage the complexities of some of these markets, I love them. And we can say that with Baltimore. A lot of people, they dump on Baltimore. It's a shrinking city or whatever, the crime or whatever. But if you have the means to find your entry point is low, and you have the means to renovate those assets, I think that's a plus, not a negative. Because I don't, you will not repeat the same rent to values that you're getting in a Baltimore pretty much anywhere else in the country. You're surely not getting anywhere in Florida, anywhere in California, really not even in Texas. And it's because our entry points are low and we're able to add value. So if I try to answer where would I never buy assets right now, I don't know.
Well, and you bring up a good point too, because it comes back to the strategy. You know what I mean? Like when you're talking about notes, you're in and out of those assets relatively quickly, right? You know what I mean? You're not holding them long term as a rental. So depending on the strategy, it is going to change a lot of that, right?
Of course, yeah.
So let's kick it over for the rental side of the business, Ron. What's your thoughts? What's your take when you're looking at a market, and you're going to hold for a long period of time compared to a quick, like fix and flip type strategy, whether that be a hard asset or the note.
Sure. I mean, when we look at a market, we want to make sure first that there's a demand, and how do you determine if there's a demand? We look at the industry that is either there or that's coming there. If it's a metropolitan area, a lot of times we'll look for cities that have a strong life sciences presence, technology, hospitals. And once we determine there's a demand, we start to analyze the different markets within the market. Geographically, where do we want to be? We look at entry points from an acquisition standpoint. What's it going to cost us to acquire an asset? What's it going to cost us to develop it? And what's going to be the value once the asset's fully developed? I've said this for years. For our model, our model's a cash flow play, not so much an appreciation play. We'll try and look at historical averages and predict a conservative appreciation. And we're not looking for markets where values are going down. But we're not picking a market just because of appreciation. We certainly, it's in the back of our minds. We're factoring it in, but that's not the main driver. So we'll go into the multiple listing systems, any public records, and we'll look at where properties are trading. What's their value going to be when they're completed? What's our cost of construction? Is it somewhere we can bring our own teams? or are we going to have to bring in one of our construction managers to oversee some third parties? So there's a number of factors that go into deciding whether it's the right market for us. But primarily, there has to be a demand. We have to make sure that we can acquire and develop for a certain dollar amount. And we need to make sure that the property is going to appraise, because we utilize portfolio refinances at the proper after repair value. Our model has always been pretty strict, and we always like to create somewhere between 30 and 40% equity in a property after it's been acquired and developed. So if we can make all of that work, and we see demand for the foreseeable future, then then it's a market that fits what we're trying to do.
Yeah. You both bring up a good point, and I'm looking at this from the two different perspectives of the note side and then the hard asset, the rental side. And the note side too, we'll have to take a deeper dive just in general of on notes, and Wade, what you do on the note side of the business, and just the different strategies within note investing on a future episode to help people to understand, because there is certainly a hard asset side to it depending on what the strategy is. And Wade, for what you primarily do, you're going to end up with a property, and you're going to have to sell that property just like you would any other property, whether you bought it in the no position or not. But I think what's coming to my mind is, if I'm putting on the hat of somebody who's new to the business, or is trying to better understand a team to invest in, I think it comes down to like the core competencies of that company and of those people that's going to drive where they land in the market. So like Ron, you made a good point. You're what you can get construction done for is going to drive where you're at in the market. You know what I mean? And what your strategy is as well. You know what I mean? Wage, your access to deals through HUD and things like that are going to drive what your strategy is, and what you do. So as like a new investor or somebody looking to get in, I think it seems like they really need to know themselves, and understand what their strengths and weaknesses are, and then kind of see what it is, what they can add to, how they can start a partnership or something, or find people that will complement. So you guys, you following where I'm coming from here? Like I'm trying to think, like, how this conversation can be beneficial to somebody who's new to the business when it comes to picking a market. There's more that they need to look at than just demand and things like that. There's initial things of what's their strengths and weaknesses and things like that, even before they decide what market they want to invest in and what kind of strategy they want to employ. What's your take, Ron? You're coming at it from a construction background. Like from my perspective, one of the reasons I partnered with you and it was because of your construction background, and that I felt like made your ability to get pricing and get projects done quickly possible. So what kind of what led you into the construction side of the business and stuff like that? Like what would your
Like, how did I end up in the construction business?
Yeah, like, because I'm trying to think about this from a person who's new to the business, like, and they're trying to get started. They're thinking, how do I get started, or where do I invest? But what market should I invest in, or something like that. But it's going to depend, like, on, well, what's your strengths and weaknesses? Like, and what are you good at or not good at, or what access to team and relationships do you have? Because that's going to depend on whether you're fixing and flipping, or buying and selling, or doing single family, or apartments, or notes, or industrial, or whatever it may be. You guys follow me?
Well, yeah, look, everybody has access to the same information, for the most part. If you don't have access to a multiple listing service, you can talk to a realtor in whatever market you're focused on, and you can get that information. So, getting the information, digesting it, dissecting it, everybody really has the ability to do that. Um, you know, Assuming you're understanding it and you know what your entry point should be, assuming access to capital, whether it be through cash or debt financing, some access to capital, you know, everybody has those same kind of barriers to entry. Where I see things always go, off the rails for people is on the construction side, because you can talk to contractors, you can talk to construction managers, you can understand, you can get bids, you can understand what something should cost. But when it boils down to that execution side of it, that's where people, I think, have the biggest problems. And, if you don't have the relationships from I'm not trying to give general contractors a bad name here, but a lot of times smaller or first time investors get taken advantage of by general contractors. They get a bid, they write them a check, and they don't do what they say they're going to do. So, there are ways to try and avoid that, or at least do your best to prevent those things from happening by getting referrals, talk to people that have done business with these general contractors or construction companies. And, that's how you can try and mitigate some of that risk. I just think, assuming you get past that, property management would be the next area where I see people have the most problems, not hiring, the right property manager. You asked me earlier how I ended up in construction and, in the late 90s, and I wouldn't advise anybody to do what I did. It was truly learning. I was young. I bit off way more than I could chew. The market worked in my favor. Our first project, which was a 7,000 square foot new construction, it took me almost 2 years to build, and I broke dead even on it. And thank goodness I wasn't married with kids, or I might have had some problems. But I also learned a lot through that whole process. And it allowed us to have a successful new home construction company at the time. So my point in saying that is I would advise nobody to go down that path. But when somebody's trying to get into investing in real estate, whether it be for a rental or a fix and flip or, a spec home, again, we all have access to the same information. And if you can understand it and decipher it, you can find out, you can find out the proper entry point, the proper acquisition. But it's that construction piece of it where I really do believe people have the biggest problem. And even, and I'll say this, and Wade can attest to this. I mean, he deals with general contractors all across the country. I mean, I can't speak for him, but I would say he, probably one of the biggest frustrations is, keeping your arms wrapped around them and keeping them to timelines, keeping them to budgets. It's difficult. It's very difficult.
Yeah, for sure.
Yeah. Because I'm trying to think when we're going down the path of, the market and, what are the kind of the key elements to look at, factors to look at in the market. And there's a piece in the back of my mind where I'm thinking, if you can't execute, it doesn't even necessarily matter. You could be in the best market in the world. Now, maybe some things would be taken care of through appreciation and things like that. You could right some wrongs over time or something like that. But, I just, the thought in my mind is if you can't execute, it doesn't necessarily matter what market you're in or what the market conditions are.
And if you're in a normal market, appreciation is not going to help you. I mean, if you look at the historical average of appreciation over the last 100 years, it's 4%. So, when we model, that's the appreciation we look at. I actually think we have like 2% appreciation in our model. You can't rely on that. You can't rely on what we saw over the last 3 or 4 years. You can't rely on what we saw, in the late '90s, early 2000s, which Wade remembers that. I mean, we had some crazy appreciation back then in certain markets. I know we were doing spec homes down on the Jersey Shore, and the appreciation was reminiscent of what we saw the last 3-4 years, and in some cases, it was more than that. To me is dumb luck. That's not anybody that projected that type of appreciation. I would love to hear their rationale behind it, because who knew a pandemic was coming? Who knew the whole work from home thing was going to become so big? So, I think you can project for some appreciation in certain markets that are evolving, where there's a driver, like a new business or company coming to that market. There's certainly catalysts for that, but that's more, that's more mild appreciation, not the hockey stick kind of stuff that we've seen, over the last 3-4 years. So I would never look at appreciation as a bailout from a failed project.
What's your thoughts, Wade?
Well, I mean, if you're speaking to people contemplating, getting into this field, whether it as an investor or as, doing the work yourself, you really first need to understand the finance side of it. Getting your debt, like if we're just buying a property that's ready to go in any given market, and you're paying market for it, you're going to have to assume your loan is going to be ADLTV, right? I don't for an investment property, I don't think they're getting a whole lot tighter. Are there any 90% loans out there right now, Ron?
Well, somebody was
No,
doing
I mean, some, but I mean, the norm is more like 70, 75
Yeah.
for investment properties.
So if you're fortunate and you can find an ADLTV loan, you're putting $20,000 down, right, on a $100,000 property. So it's eating up cash quickly. So how many of those can you do if you have to keep writing $20,000 checks? It's probably limited. If you have the ability to renovate, then you can buy that same property, say for 40, put 60 in it, and refinance it, and get all your money back. Right. So now you've refinanced a home and you have 100% of your cash back to go do it again. So understanding how the financing side, the debt side of this venture works is super important. And then if you can blend that with an ability to either oversee the contractors or be the contractor yourself, to keep most of that value add to yourself, it's a huge benefit. Huge benefit. And to Ron's point with what we do, I usually have to hire a contractor, in Rhode Island or some state far away, and he's got to make money on the deal too. So whatever I pay for that construction is probably 20 or 30% higher than if Ron was doing it himself for the benefit of the portfolio. So even when I hire a GC, I gain equity by virtue of fixing a distressed asset. I'm still paying likely 20 or 30% more than an individual doing it himself. And again, if you're talking about 20% down on a house, that's it right there. You've earned that 20% for free, that sweat equity, which is invaluable. So, Peter, to your point, looking a little bit of introspection. What are my skill sets? What am I capable of doing? And then marrying that with the type of debt or lender you're working with is a huge game changer. Am I writing checks to buy these things, or are the properties writing those checks for me? It's a huge, huge difference. And that's the difference of being able to do one or two or doing 20 or 30. It's math.
Yeah.
That's all it is.
there's so many like different pathways we can go down here, and I'm like so many questions are firing through my brain right now, because I think there's you know the, people ask me, I mean, why do we invest in Baltimore? You know, I mean, or why do we invest in Philadelphia? And there's a lot of reasons, but one of the reasons that I come back to is, well, that's where we're from. You know, I mean, that's where we're from. That's the markets we grew up in, that we know, and that's where our boots on the ground, and that's where our teams are, and we have guys and people on the crew that can execute in those markets. So I think, so many times from a general standpoint, people look at, certain factors for the market that would drive people to invest there, but not everybody, especially smaller investors, not everybody has the ability to just go to some booming market or something like that. And then to your point, Wade, earlier, booming is going to drive a lot of competition as well. It's going to be harder to find those, discounted properties and find value. So it seems like there's a lot more to it. It's not just about finding this great market, and maybe I think it differs from strategy too. You know what I mean? Because I think I see a lot of friends of mine who are multifamily syndicators, and they're just constantly going to booming markets. I mean, where there's tons of competition, where a lot of the appreciation and economic growth in those markets, I think, have already been baked into the prices. So what's your take, both of you, on a booming market versus a more stable market versus the market that's close to home, where you have connections and you have boots on the ground and you can get things done? What market would you guys rather be in?
I mean, you obviously want the drivers for the market. I mean, there needs to be something to create the demand. Obviously, you would prefer to have it closer to your home base. That doesn't mean that, certainly we could execute another market as well. It's a combination of factors. You got to take into consideration the scale you're looking to achieve. If you're trying to be in Invitation Homes, you're going to have to go to multiple markets to get over 100,000 doors. If you're looking to acquire 1,000 properties, that's something you can most likely, if you're near a metropolitan area that has that demand, you could do that in one market. So, I think there's more than one factor there. It's, what's the scale you're trying to achieve? Is it, is there has to be a demand there? And certainly if it's closer to your home base, that would be preferable.
And I'll ask you this in a second run too, but Baltimore's somewhat reminiscent to me of Houston back, I guess it was the late 90s, early 2000. And this is kind of what got me into real estate in the first place. But there in Houston, there is no geographic limitation. The city would just grow out and out and out. And sometime around whatever, 99, 2000, all the new construction was, an hour and a half outside of downtown. All of the single family homes immediately around downtown were all war zones. Crack houses, dilapidated, boarded up. No one wanted to be there. So in the suburbs, we would drive past all that dilapidated property to get to, downtown Houston, wherever you're working. And it got to the point where it was so ridiculous to get from the suburbs to downtown that people finally started buying these crack houses right next to downtown Houston, tearing them down and building these big 3-story townhouses and whatnot. It became a big deal. And at the time, I was snapping up little vacant lots around in the town, and we saw lots, trading for a few $1,000s to 50 cents a foot. It was insane. And you kind of look at Baltimore the same way, but it actually has geographic limitations all to the southeast because it's on the coast. but your downtown city hadn't changed. It's still downtown Baltimore. So new construction is happening in the suburbs. It's more difficult to get in town. Yet there's all these dilapidated and vacant homes that have been abandoned for a decade, all in and out and around Baltimore, which is where your hospitals are, which is where your mail is. All those big perks of a big city are still downtown. Suburbs are getting further and further away. So I think there's an opportunity here, the whole value add. You can't really build new construction in downtown Baltimore. So you have to find available assets, and there's plenty of them in Baltimore. And that's exactly what you're doing. You're adding value by virtue of buying existing assets that have been overlooked for a decade or more.
Yeah, I could be, don't quote me on this, but I think I'm generally right here. I think there's something like 17,000 vacant homes in Baltimore City. Um, you know, People ask all the time, well, why doesn't a bigger company come in and redevelop that? It doesn't really fit their model. That's not what they do. The bigger companies, 17,000 homes sounds like a lot of homes, and it is a lot of homes. But you take like an Invitation Homes or, a group like that, that's not what they focus on. That's not the price point they focus on. The metropolitan redevelopment asset is not what they do. So for a big company to come in, or even like a BlackRock, and spend the kind of money they'd want to spend, I don't think they could do it. I mean, they certainly could spend the money, but then it's the process in and of itself. It's like the redevelopment of that. So yeah, I mean, it's people ask me all the time, well, why aren't more people doing that? It's easier said than done. The barrier to entry is not difficult from a price point, for sure. Finding competent builders or general contractors, you can and you can't, and then on top of it, managing scattered site single family homes is a whole nother component to this that doesn't get talked about a lot. But that's not like managing a 500 unit apartment building. They're two different products, totally two different animals. So I know I'm kind of like talking in circles here a little bit, but there's no question that there's the demand for the housing there. The big problem has been finding incentives, and I think a lot of this falls on the city to one extent or another, for developers to come in and redevelop that stuff. Because again, large developers don't want to go buy 3 on this block, 5 on that block. They want like 15 blocks. And that's, you can't really do that because there are homes on those blocks that are owned by people that aren't going to get sold. So there's some complexities to that.
Well, and that Wall Street Journal article where they're talking about these big rental outfits, Invitation Homes and those, I mean, when they're buying a single family for rental, they usually limit the construction on that to about 10 or 12 grand.
Yeah.
And those would be items that don't require permit, number one, just for simplicity's sake. And then they admit here that they're actually doing better when they develop entire neighborhoods, new construction. But again, that's very different, where you're not having to pull individual permits or assess the specific deficiencies of whatever asset scattered all across, a city. Rather, they have a 15-acre parcel and everything is uniform. All the same items are going into every single home. See, and it's in a single location.
Sure.
It's a different animal. And if they were doing that in Baltimore, they'd be in the suburbs, which isn't solving the problem, the inner city problem.
No, it's not solving the affordability problem either, because you look at the average price point of the homes that are developing in those new construction, developments. They're not $185,000 homes.
Yeah.
They're 300, 350 upwards. And it's different also because you're hiring a large building company to build those homes. It's very different than in the city where you're going around, it's predominantly rehab work, although the majority of like what we do is taking buildings down to the bricks and then reframing. Everything's brand new for the most part. So, it's like new construction to an extent, but it's not, and it's not consolidated. So, really talking about two different animals.
And I think too that we talked about markets that are boom towns, and everyone seems to want those, and they're all focused on equity. Fine. We're focused on cash flow.
Yeah.
And if you look at the typical cash flow of a Baltimore property, one of ours, what's it, $400-500 net per door. That equates to about a 3% appreciation rate. And then on top of that, we're still getting the 2 or 3% appreciation rate. So now our total number is 5 or 6 versus some of these guys. If you're trying to rent out a $350,000 home in the suburbs, your rent to value is going to be poor. You're not going to make $500 a door. In fact, a lot of people are just trying to break even, and they're living and dying by that appreciation rate. I just think it's crazy when you could get both.
Sure. And and what do you really? I mean, what constitutes a boom town anymore?
Yeah.
I'm not picking on like Montana here, but like you take like a Bozeman or something like that. Somebody wants to call that a boom town. That's more of like a second home boom town, or someone like Coeur d'Alene, or a luxury, something that's more luxury focused. I know, Peter, you're really talking about something that's driven more by industry, but even that's changed a lot, since the pandemic because of, the work from home environment. You take, one of my favorite places, Charleston, South Carolina, you take a place like Daniel Island or Isle of Palms, that real estate went through the roof when the pandemic started because people realized, hey, I'm going to go work from home, but I'm going to move down there. So what you got to look at what the drivers are again for something booming.
But then also the support of that, like the issues we're having up here in Montana is all these people from out of state that can work remotely, and I'm one of them, moved up here, but now we're overburdening the service industry. Right. So you're paying the Taco Bell guy $20 an hour to make a taco. I mean, that's not going to last forever.
Right.
Versus, an old boom town like Phoenix years ago, where there's enough cheap housing there that you can support a service industry, even if values do get a little bit ahead for a while. At least you have a city with enough industry and both service that can support growth. Versus these small towns up here in Montana and Coeur d'Alene, they're going to get killed in a few years.
Yeah. Yeah. I mean, I think you really have to look at what's driving the appreciation in some of these markets. And a lot of times that appreciation doesn't translate to appreciation in rents either. Or at least appreciation in rents that make it investable, from that standpoint. So, kind of going back to what we talked about on the last show, this information on the surface, you really got to peel back the layers to understand it and understand what's happening and why it's happening.
Yeah,
because it's not the same in every market.
Yeah, there's major differences between what the institutional single family investors buy and what the average mom and pop and just average regular real estate investor who buys a couple single family homes, and even just your regular even larger companies that own hundreds of houses. They just go about the strategy completely different, and there's so many reasons for that. But I think one thing, and I've seen this from Invitation Homes and other companies like that. They're buying off of location. I mean, it's all about buying in those, high appreciation locations and things like that. And I think sometimes people confuse they confuse the asset class and type with location. I mean, whereas oh, well, Baltimore, isn't that a bad location? Or isn't, certain North Philly or Chester, or, whatever the area is. I mean, isn't that a bad location? But that's where it comes back to demand. I mean, what's your strategy, and what is the demand in that area for it? I mean, because if you're investing in affordable housing, and you're that's where you're going to find, strong demand for those types of rentals and for that type of product. It's the same thing in other parts of commercial too. I mean, you can have retail behind other retail that's in a great retail corridor, but it's not well located in that sense. Same thing with office. I mean, so many people right now are extremely anti-office, and office has a ton of problems. But if you're in a really good location and you have a certain type of office, I mean, I see it here, Ron, where we live, there's still offices that are 100% occupied that are doing just fine, because they're in a really good location. So, I think location, is different from depending on the strategy, that kind of thing. Am I making sense? Is that, because I think that's something that comes up a lot.
Well, yeah, and when you look at where these big companies are buying the single family rentals, you talk about demand, and why are they focusing more in kind of that, the Sun Belt, right? What I can tell you right now, where I live in Chester County, Pennsylvania, the demand is massive. Homes hit the market. They're gone. A lot of them are cash buyers. There is definitely a component of higher end houses, but there's also a component of, around here, the middle market house is probably around, $600,000, $700,000, $800,000. Those things are flying off the market. As soon as they're on, they're gone. Why are those big companies not focused around here? So, and maybe that's a conversation for another episode. But I think that'd be interesting to kind of delve into. I think a lot of it has to do with the cost. It's not just it's not the demand's here. And there's other markets that are not second home or luxury markets, but are a higher price point market where there is huge demand. So why are they not addressing that? But I think that's something that would be worth discussing later.
Yeah. Let's put a bookmark in it. I mean, let's call it a show here, and we'll pick back up and continue that conversation on episode 3. Well, there you have it. Thank you for listening to the Real Estate Investing On Point podcast. Be sure to subscribe and join us live on one of our virtual meetups. You can find more information on our website at gsprei.com. That's gsprei.com. Thank you again, and God bless. We'll look forward to catching you on the next one.